Davos and talking to people here made you cheerier or more pessimistic?
Well, I think the mood is relatively optimistic, and I think it's optimistic with some soberness. There's work to do. In the developed countries, there's work to do. In the developing countries, the growth is sort of restored, and so China and India and other countries seem to be back on track with stronger growth. But in the developed countries of Europe and U.S., we need to do a lot of work to get people back to work, and then economies can grow better, and that's going to be increasing competitiveness on a worldwide basis. And I think, but instead of talking about whether the euro is going to break up and all the things that were sort of last year's discussion, it's more a lot of the fundamental structures in place. Now it's just time to get to work and really work on the fundamental economic questions as opposed to unfundamental crisis questions.
And does that approach hold also for the Americans? There have been a few crisis moments of late. Do you feel like they're sorted out now for the rest of the year?
I hope so. And I think, but I think the fiscal debate in the U.S., fiscal cliff, and then the debt ceiling and stuff, that does not help. And what I get worried about is that the consumer has been very resilient in the United States. The spending that consumers do in the month of January 13 versus January 12 is up 6%. And so we see a lot in our credit cards and debit cards. We have about 40 billion spent a month on our Bank of America branded plastic. So it's not a small sample. And you see it go forward and keep being constructive. What could get the consumer to slow down if everybody keeps telling them there's a crisis? And so we were worried through the fall that would happen. We didn't see it. The Christmas season was okay for retailers and stuff, and you can see the numbers there. So we feel pretty good. But the more we debate that we have some big crisis that we can't solve, the more chances you have the consumer to slow down.
Now, when I talk to bank CEOs, including some of your American brethren here in Davos, when they talk about uncertainty, one area of uncertainty they like to talk about is the regulatory environment. And sometimes they will add that re-regulation has gone too far. Do you share that view?
Well, I look at it more that if you think about the principles that we needed to do, we needed to recapitalize our industry, and that's done. We needed to narrow the scope of our activities, and that's done as an industry in terms of prop trading or private equity in our company. We've been sizing it down. We need to build more liquidity. We're 4 times the liquidity we were 3 years ago. So all those parts of the regulation were very strong, and that they have brought the American industry, frankly, to the strongest place in capital in the world, maybe as on pure numbers to the Chinese. Like our company has the most tier 1 capital of like 2 other banks in the world, Chinese banks and stuff. So we're strong as an industry. The question of the overregulation stuff, I think we just need to get a set of rules set and then keep fine-tuning them. There's just a lot of work to be done, and I think people, sometimes that's an expression of fear what could happen as opposed to what's happening. But I think there's a rational path forward. The dialogue is getting stronger. We have to be careful to balance regulation with the impact on the economy and things like that. But I think that dialogue's going on. But the real question is we got to get some set of rules in place so we can figure out what to do.
And how do you like the look of Basel III?
We report on it every quarter. I mean, we report as if it's 2019. Our ratio for the fourth quarter is 9.25 or something like that. And so we're compliant with 2019 today, and we give great detail. Its principles were higher capital, less risk, more of a tightly wound franchise. In other words, a franchise where everything you do is really to support the customers and the core economy. And we absolutely believe in that as a company. That's what we've been doing. So that's how we got there as fast as we did.
Is a side effect of your approach, driven perhaps by a new regulatory environment like Basel III, going to be to make banks safer for the rest of us, for the rest of the economy?
Well, so the high point, we had about $2.7 trillion in assets. We have 2.2, so $500 billion of downsizing. Our capital has more than doubled from 70 billion of tangible common equity, 140 billion round numbers, in 3 or 4 years. So if you just think about that, our liquidity has gone up by 4 times. So the amount of capital we have after the stress tests and things like that is more, in some respects, than we had at as we entered the crisis. So by definition, those help the safety soundness of our institution. By the way, the other institutions have all been doing the same things. The second thing is, if you worry about what we call dangling participles, a risk that you don't know, if you're going to be in something, you got to understand it and manage it well. And that narrowing of the franchise and make it more simple, less complex, less jurisdictions, focused more on where you really have competitive advantage, that makes a company safer and easier to manage.